Hello, everybody. So I'm back from the Thanksgiving break, and getting back into YouTube and making kind of an easier video for me today, because I want to talk about some positivity that has happened to my portfolio, and maybe you own these two stocks, StoneCo, STNE, and HIMS, and it's true that they've had an impressive run in a matter of 1 month, both of them, with HIMS being up 45% and StoneCo being up 53% in just 1 month. It's almost the entire year to date return. I mean, for HIMS and hers, it's their entire year to date return in a matter of 1 month. So it's to tell you how vastly undervalued and negative the market really was back in October of this year. And sure enough, I was making a few videos, pounding the table to buy at these prices. But I've also made videos, telling you that in my view, HIMS was cheap at around, $9 and $8. And so it doesn't change anything. StoneCo was cheap at 13. It is still cheap at these levels. It's tough to, want to go and buy a StoneCo, for example, now 1 month later, and it's up 50%. It seems like you're not getting as good of a deal. But when you zoom out, these stocks are still dirt cheap. In fact, I've briefly updated my spreadsheet here with a new valuation from these stocks, and based on my metric, enterprise value over gross profit over a next 12-month revenue growth. So revenue growth is excellent for these two companies. If you use my metric EV over GP over RG for each of these, I get to a 0.04 and a 0.068. So these stocks used to be a 0.03 and a 0.04 respectively. So that hasn't changed at all, right? If I use the same metrics to other stocks that I love and other stocks for which I have a much bigger position, for example, Enphase and Tesla, respectively my number one and number two stock positions, if I look at these stocks, they're at a 0.74 or 0.36. So obviously, in my view of investing, this value metric, right, should not be the main reason why you buy a stock. I don't think buying a stock just because it's cheap is the right style of investing. And I should be careful saying that because I was tweeting earlier about Charlie Munger, and of course he was a big advocate of value investing. It's more than just value. But when you have a wonderful company, when you have a business that's growing very, very fast, and on top of that, the valuation is very cheap, in my view, these stocks are still a buy. These stocks are still a buy. Why are they still a buy? Why am I still buying these stocks? Well, if Macro Trends ever updates their website, I could tell you more, but this is helpful in looking at a long-term view. So company right here is HIMS. If you look at HIMS, their price to sales ratio is a 2.11, and you can see it's been extremely flat. This is actually StoneCo. These charts look about the same. This one is actually StoneCo. Just looking at the chart. So because you can see their drop. So the price to sales is still roughly the same at $15 for StoneCo, and the same is true for HIMS. HIMS is actually still the cheapest price to sales you can buy, right, at a 2.16. You can see, go back 2 years ago for these companies, and 2 years ago you had HIMS. Well, 1 year and a half ago for HIMS, it was trading at a 3.5 to a 4, and StoneCo was trading, between 20 and 30 for StoneCo, between 20 and 30. So even at these prices, it's still 10x cheaper relative to what this was. And of course, I would never buy a stock just based on a cheap valuation. But there's qualitative reasons, there's fundamental analytic reasons, fundamental analysis you can do as a reason to decide to buy these companies. These companies are predicted to keep growing between 40 and 60%, depending on the company you look at. Analysts are saying plus 39% revenue growth for StoneCo over the next 12 months and plus 57%. And you may know, if you follow these stocks like I do, in my view, StoneCo will be closer to 45% over the next 12 months. And HIMS, in my view, will handsomely beat that, this 57% prediction. Because if you look at these companies qualitatively, there's a few charts I want to show you as to the categories that we're going to get in. So this is StoneCo. StoneCo right now is in Brazil, and they handle payments for medium, small, and micro businesses, and they've just gotten a little bit tiny bit into banking, right? They just do a little bit of banking for small businesses, getting back into that business, a business they had exited back in 2021 after having a collateral issue, which is the reason why StoneCo stock is still trading at a depressed valuation, right? They made a mistake. They lost $500 million, but the shareholders lost $20 billion, right? Because the stock never went back to the level what it was. And I believe this is still a stunning company, all owned by both, well, Buffett and the Cathie Wood. So you know, who knows? Maybe Charlie Munger had a say in this investment. I don't know. The point is, if you look at these four stocks, right, they're barely doing any banking, and this is their vision. They want to do banking, they want to do software, they want to do credit. So if you look at this chart and how much bigger the company could get, you can see that's at least a 200% expansion in the categories for this company, and probably more if they ever decide to go international. My last video that I talked about StoneCo, you know, in my view, if you use this quote-unquote copy and paste business, I find it interesting that StoneCo is international. Maybe when the stock market recovers, maybe when this company's success continues, they will think about going internationally down the road. So StoneCo is doing very well, and for HIMS is a similar story. HIMS actually has a little bit of international business in the UK, but for HIMS, they're nowhere near that international growth just yet. So they're mostly a US company growing in the US, and they are moving very fast, introducing new products very fast. You know that they've announced weight loss now about 20 days ago. That was my slide from a few weeks back. So they've announced weight loss, and about 3 months ago they announced cardio. So that's two new major categories that they've announced, categories of drugs. If you know anything about HIMS, you know it's an e-pharmacy and an e-doctor that you access without having insurance or without having to use your insurance. So it's two disruptions: the disruption of the platform, e-doctors, doctors registered on the platform, getting paid to give their medical advice and getting paid to recommend a prescription. So that's one aspect for HIMS. And then the digital pharmacy, right? There's 45,000 pharmacies in the US in the era of speed, quick shipping, right? In the era of same-day shipping, do you need 45,000 pharmacies? I don't think so. It's an agile company. You can see they have a tremendous amount of areas to enter. And if you look at the bigger markets, right, so they went after the quote-unquote low-hanging fruit, right, and they still have a few, like prostate treatment, testosterone treatment to get after for men's health. Women, they still have a lot of products to offer, but they have an offer for their heirs platform, like menopause, right, dermatology, eczema, rosacea, mental health. PTSD is a big area. So is insomnia. So is, you know, helping people who are addicted to substances. 50 million plus people are after. And look at their new category, prospective markets, right? Weight loss that they've just entered is just one of them. If you know anything about, for example, diabetes is a huge field as well, where you need to take treatment. These are categories that this company will enter into. These companies, whether it is StoneCo and the size of their market and what they have to enter, or whether it is the US and the size of the market, the US being about 100 million people more than Brazil. Brazil is actually a huge country with 250 million. These two companies have growth within their categories, within each of their categories that they sell, right? So payments for StoneCo and different medications that you see here for HIMS. And they have growth also with the number of categories, how many categories they're going to be able to get into, which is what makes me very excited to own these companies for the long run, because obviously it's going to take 5 years for these companies, for StoneCo to get there, right here in this chart where they cover everything, and for HIMS to get here where they have everything covered. They're only halfway through in the type of conditions that they can cover, and every time each of these categories, within the category, you grow too. So am I still buying StoneCo and am I still buying HIMS at this level? Yeah, I'm not doing any oversized buy like when HIMS was trading at 5 and change. If you remember HIMS a month and a half ago trading at 5 and change, I was buying more. Not doing any oversized buys on any of these stocks right now, but it is a regular DCA candidate, right? Dollar cost averaging. They are a fair candidate for new money into the portfolio. That's the way I look at it. Okay, right now my focus is more on the stocks that I personally find very undervalued right now, which are Enphase, especially Enphase, Tesla to a lesser extent, and Bitcoin to a lesser extent. I find these two stocks and this third asset to be very undervalued right now. So I'm focusing my buys on those, but StoneCo and HIMS by all means are undervalued by traditional metrics, by all of the traditional metrics. If you look at Tesla, for example, per traditional metrics, you might absolutely not find it undervalued, but you always gotta put the price of a stock in perspective with their future potential and their future prospects. I'm hopeful for another drawdown, although I mean, you never know. All it takes is Jay Powell being stubborn at another meeting, one more time, and these stocks, could get back to these old levels. I don't think that's going to happen because I believe in math, but I didn't think that the bluff of the Fed would last this long. I definitely didn't think, and the bluff of the Fed has lasted this long, which means that the rate drops is going to be just as rapid, just as quick as the rate increases. Because in my view, rates should have never been this high. And I'll finish this video with a quick word on Charlie Munger. Obviously, I disagreed. I mean, I don't need, there's no agreement or disagreement. He's a huge figure and I'm just a random person. But I obviously did not think a lot of the prescriptions that he had, for example, calling Bitcoin rat poison, right? In the early days of Bitcoin, calling it rat poison, obviously not something I agree with Bitcoin being my bond alternative and my second position. Nonetheless, Charlie Munger, if you read his quotes, if you study his advice, his humor. I mean, he was the second figure in investing after Warren Buffett. Like, if you ask people about investing, in my world, it's Warren Buffett first and Charlie Munger second. And even though I'm obviously not a value investor, I feel like I've known this man my entire adult life. And I find it personally a little shocking, the coverage on CNBC trying to sell Navage or whatever nose treatment or bath remodel on CNBC and not interrupting their programming because he was a superstar of investing. But no, you got to talk about the drama about Sam Altman and the drama about, Las Vegas Sands, whatever. I think anyways, because think about the media. Think about how many headlines Charlie Munger has given to CNBC, and he passes away and he barely gets a headline. He's like the number 3 headline. I'm on CNBC.com right now. He's number 3. Like, number 1 is something about Las Vegas Sands. And anyways, it's just kudos to X, kudos to Twitter. If you look at the number 1 trending topic on X and Twitter, it is Charlie Munger, and it's as much as I disagreed with him, it's a very sad news, and I just they should have special programming, but it's my fault. I shouldn't be watching CNBC. I should be just being on Twitter. So anyways, rest in peace, Charlie Munger. Rest in peace. I have so many stories that I've read about him. Him and Buffett going to Disneyland, studying Disneyland, whether they were going to invest in Disneyland as opposed to paying attention to their kids and wives, but taking notes about Dumbo and writing Americans love Dumbo. I mean, great stories about this. Anyways, I know I'm not the only one. I see it on. Rest in peace, Charlie Munger. It's a very sad news for anybody in investing. Anyways, this was not investment advice. This is just entertainment. I hope you were entertained. I appreciate your likes. I appreciate your subscribes. Please follow me on X. Thank you so much for watching and have a wonderful day.